Well, hello and welcome to another in our series of Choice Words videos where we get to meet key decision makers from the world of UK fund selection, UK fund research and find out what makes them tick. I'm Julian Marr, I'm Editorial Director of Wealthwise, and I'm delighted today to be talking to 7IM's Head of Portfolio Management, Uwe Ketelsen. Hello, Uwe.
Hello, thanks for having me.
Oh, it's a pleasure. Absolutely. Thank you for joining us. Jumping straight in, as I've learned to do having watched the intros of my previous recordings, what excites you most about the current investment outlook? What worries you, gives you pause for thought?
Well, the source of excitement is probably the same as the source of my worries, I guess. I mean, the great news, I think the great news is that we finally don't have to manage anymore around 7 US stocks plus minus, so that the playing field is more open, there's more room for selection, there's more room for asset allocation, actually have success with it. So it has been a really tough 2 years to work around these or manage around these 7 or so names. I think that's the good news. The bad news is that I think that our mantra has always been ignore politics, think long term. And I think we've now reached a new era, as people refer to, where actually politics and the changes in politics have economic implications, and that's quite hard to gauge. So we're talking about Trump, but it's not only Trump, it's a global phenomenon where the political measures will impact inflation rates, currencies, monetary policy, fiscal policy, and the implications of that are not quite clear to me yet, but we can't ignore it anymore. I think it's an opportunity, but it's also a concern.
That's a very succinct summation of world affairs. Excellent, good basis, good jumping off point. I'm almost regretting having to have got that wide view to come in quite closely now. But in terms when you're picking investments, funds, or individual stocks, whatever you're doing, what do you look most for in an individual investment? What would you consider to be a serious red flag?
So what I'm looking for is value for money, not in the regulatory sense, but really is the value add from that investments that I see for the off-the-shelf price or the price that we negotiate, does it add value to my portfolio? And like I remember when I came to the UK many years ago, there was a talk about closet trackers and basically unreasonably highly priced investments adding little value. I think now we have way more choice out there, and we have index plus, enhanced index, quantitatively managed, whatever investment opportunities that are taking low risk for a low cost, and that's a nice addition in a certain portfolio context. So there's a way more open playing field to look at stuff, and as long as that my expected return stands in a good proportion to the cost for the investor, I'm quite happy. What is a red flag? Probably change in the liquidity profile is probably on the top of my list. A change or continued change in team structure, the turnover is a second one, and the often quoted style drift. If it is unexplained and unannounced, that's another one where you see a portfolio morphing and you can't reconcile it anymore with what actually the strategy officially is meant to do.
Well, you mentioned style drift, and that is interesting. I mean, it's something we've seen. It's a constant risk for someone that you need to be moving on. Funds are building blocks. You want that building block not to change shape, as it were. Otherwise, the whole structure comes tumbling down. Trouble is, when to pick one value's been out of favour for large chunks the last 10 or 12 years, you wouldn't be human as a fund manager or as a value fund manager. You thought, well, hang on, there's wonderful stuff happening over there, and you morph. So, bearing that in mind, how do you cope as a fund selector with points in time when it might be uncomfortable for other people, possibly for yourself, but also when the people you're buying maintain their own investment discipline? What do you do to keep control of that?
Well, I think portfolio discipline is important for us, and we are fund selectors. We are also asset allocators, so we want to make the value versus growth decision, and we want investors or fund managers we employ to be true to the label. So this is a trivial thing to say, And I feel sorry for a value manager over many years. I mean, we know value as a style very long term is actually a very good place to be in, but there's extended periods of time where this doesn't work that way, and I think that's commercially tough maybe for those houses. But I think it is important that they stay true to their style. That is different from saying that a strategy or an investment process can evolve.
Sure.
So that we definitely expect. And when there's a manager who says, okay, we've done it this way, now we're doing it that way, and they explain to us why it's doing it, we say, well, that's a proper learning from the past and refinement of your process. That's okay. That's actually a good thing. So I think there's a shades of gray in how we can actually look at this whole subject of style drift.
And how do you have then? If you see if one of your holdings there is the manager is moving away from what you would think is what you bought it, you have the conversation, do you, and say, look, what's going on here? How does that work?
Yes, I mean, my analyst, my team, I mean, the whole job is obviously to also stay on the top of what we invested in, and you have now all the great toolkit available to notice these things very early. You can look at it as often as you want. Every single stock or security is held. So when you see stuff that doesn't feel like what you expected, the first thing is to have a conversation. Yes, and there might well be a good explanation, but if it is basically not a good explanation that we can't reconcile, then usually the expectation would be it's a temporary holding that's maybe still within sort of the prospectus, let's say, but nothing where the manager says this is a new era and we just do it that way. So the conversation is important to have first. Yeah, is it accidental? Is it maybe a new analyst in the team who has new ideas, or is it something where actually manager secretly tries to change the game a little bit? That's a concern.
Excellent, thank you. Now, earlier you mentioned there's a whole range of different investments you can move into. So let's see with my next question. The first part, the answer is yes, which is to what degree should professional investors be thinking beyond traditional equities and bonds? Let's move straight on towards what? What are sort of alternatives are you looking for beyond that?
Yeah, well, alternatives have been, certainly at 7am, part of the portfolios for a long time now. And then when you look really like 20 years back, what alternatives were, so we've moved from offshore, unregulated, expensive 220 fund of funds to liquid alternatives, bit cheaper, still expensive, compromised investment style, still the same thing, but shoehorned into the sort of a usage framework. I think where we've now arrived, certainly at 7, is actually say there are interesting alternative style premier alternative payoffs that you can actually access very, very cheaply and in a very liquid format. The most obvious one being Trend, which is a brilliant diversifier, even in a cautious portfolio context. And you can get it for a fraction of the shelf price through an expensive manager. So that's where we are now. And the other thing is what you communicate to your clients. And remember, the old days, it was like equity-like returns with bond-like volatility. So of course, long-term, it didn't quite work that way. When you construct something that is not meant to shoot out the lights, but in a liquid, cheap way, just be an alternative, say, to a low-risk government bond portfolio or a high-quality credit, corporate bond portfolio, that's a more reasonable benchmark to say this is what we will try to beat as a pair trade, not more and not less. If you position it that way, then alternatives are a brilliant alternative to other holdings in your portfolio.
Thank you. Let's move into investing for good, as it were. Yeah. My glib question is always, what does ESG 2.0 look like? What I mean is clearly investing in companies that do good has evolved over the last 25, 30 years. What's the next stage of it? How do you approach it now?
Well, we've at 7, we've always separated quite clearly what we're doing in our responsibly or sustainably managed offering on the model and on fund side and outside that. So outside that, what we're focusing on is just fund managers doing what they should be doing other than managing money, which is a good level of voting and engagement. We do expect that from fund houses, that they're active there. but we don't expect a responsible investment strategy. That's absolutely not the case. Within our responsible offering, I think it's interesting to see how we are like in real time now seeing it changing in the landscape. 2 years ago, you wanted to hire an ESG analyst, and that would come at a premium in the job market. I think everything has now normalized a little bit, thanks to Trump and others. You see one after the other big US houses dropping basically the guard and say, we're dropping net zero and all the rest of it. And you now have a way clearer choice of fund houses and fund managers that are clearly in the game and want to offer something and really expertise, and others who do not. So there's one, I think, an industry change that we see. Then I think something that really annoyed me over the years was this proliferation of indices and ETFs tracking those indices has been an absurd level of inflation. I think that will normalize a little bit, and you will have a clearer and simpler choice what you want to access. And as this means there will be a more distinct offering from Seven or other asset allocators, where we say this is the stuff where we manage not only for return, also for return, but we also want to do something good, whether it's environmental terms, in human capital terms, and social capital terms. But I think, in a nutshell, what we see now is the industry really going into clearer two camps, where nobody will anymore pretend to do one thing and do something else. It will be now very clear who is on what side of the equation.
And is that your official sort of take on it now, that when you mention environmental, human capital, social capital? Because I think one of the things with ESG, I think I used to write about MESG, it's such a personal thing. That's your way of judging it. So people can go, well, actually, that's the bit I'm interested in. So that's how they head that direction.
I think these are every investor who has an interest in this will have a slightly different interpretation and that set of values. And I think you, as a provider of a solution, I think you just have to be clear: what are you screening out, what are you avoiding, and what is part of it, and then the investor on the other side has to decide whether it meets his or her expectations or not. So we have it reasonably clear. We have a controversial weapons policy that covers everything. We have a decarbonization target that covers everything in our portfolios, but beyond that, we have a clear set of screening criteria that we are open with our investors or prospects.
Excellent, thank you. Let's move on to some more personal questions now. That sounds more ominous than I meant it to sound. What was your path into investment, and what in an alternative universe do you think you'd be doing if you hadn't taken that?
I'm a trained economist, and I started in economics. I moved into risk management. I realized you're not rewarded very well, not only monetary terms, but nobody really cares about the risk that you're avoiding. So I felt I wanted to be actually in the return generation and actually a bit closer to the client. So that was my nearer term motivation back then. I was at that time working at Swiss Bancorp, or UBS, as it was merged in Switzerland. Mm-hmm. And as it goes, whenever you have corporate action, you can't really move anywhere within the organization. So I had to move outside to actually get into that role. And I've stayed there. And obviously the industry has evolved a lot over the years. The way I look at us now, and I think this is also thanks to regulation that has, I think especially in the UK, has evolved in a good way. I think we're generally doing something good and something helpful for investors. 95 or 98% out there don't really know what to do with their money, and they make the biggest mistakes with their wealth because they just don't know how to do it. And that's very normal. You and I, we're not doctors. We don't know what to do when we have an ailment of some sort. We go to experts to seek help. So I think we're actually doing something really, really good and important for clients. And with every year that I'm clocking up in the industry, I feel very confident and comfortable that we're actually really adding value to people.
Okay, and the alternative universe, you'd still be in risk management, or you'd be doing something completely?
I would go straight into the investment management, I think, and not risk management anymore.
I guess the trouble with risk management and avoiding risk is the clients only care about it if the risk isn't avoided, and then you hear about it.
Exactly. And I think it's like in every sort of well-organized organization, you will have an independent risk function. We have it at Seven as well, and it's a very good collaborative process. So and when you're constantly kept on your toes, then you don't take those undue risks in the first place. So I think we're beyond that stage where you have like this nasty investment manager who's doing weird things unless he's kept in check.
Completely independent question from what we've just talked about there, but what is the biggest investment mistake you've ever made or you're prepared to admit to, and did you learn any lessons from it?
Well, I think there's probably a lot of little mistakes over the years. I think if I had to pick one thing, it was still not a big error, but something I wouldn't want to do again is something that I've learned more than anything else. If something is more important to investors than returns, it's to be able to get the money back and the importance of liquidity. And there was a long time, obviously, when our industry would also buy open-ended property funds. And that's one of the lessons that I've learned, that don't try to shoehorn an asset class into a fund wrapper or a vehicle that is just not corresponding to the underlying asset class. So I would, going forward, and this is how we're managing money now, we stay out of real assets that are unlisted in nature and illiquid in nature. And it was painful to sit on well-managed open-ended property funds for years that couldn't return the money.
Yeah, sure, of course. Okay, so liquidity really has come up. This is what's coming through this conversation a few times now. Liquidity to you is absolutely premium. Joke. Again, completely unconnected on anything to do with property funds or what we're talking about. If you head of the FCA for a day, what would be your priority? What would be the first thing you do?
Well, okay. So first of all, I would, as I said a moment ago, I think actually the degree of consumer protection we've achieved here and the FCA has achieved is really, really high. And I know a little bit the regulatory environment in my home country in Germany, in Switzerland, where I've worked a long time. I think the level of protection of the consumer here is really, really good. And that's credit to the FCA. And if I was the head of the FCA, I would be quite proud of that. Probably two bits that come to my mind I would focus on. One is closed-ended, which is always a little bit, and there's a lot of talk about fees always on a regular basis, it pops up. To me, is also concerned what is actually accessible to the retail investor in a closed-ended shape, sometimes very sophisticated investments. Private equity, hedge fund style strategies. That worries me that this is not better regulated. The other thing is I have to mention SDR and the way this has been handled by the regulator, which is an absolute mess, to be honest. And I think the regulator should maybe, and I as a head would make sure that we do that, to take a step back. Are we really overstepping our mark a little bit? Should we rather, take back this level of how prescriptive we are on the industry and just set guardrails and just make sure that the industry is telling the consumer what the consumer needs to know to make an informed decision. But that is not try to define strategies and label strategies in the way that it was done with SDR, which I think was one of the worst regulatory achievements of the recent years.
That's interesting because there's a really weird experience here where I'm actually on camera about to defend the FCA, which I've never. But I suppose it's not really defending to say that I thought the UK approach to regulating sustainable investing was substantially better than the European approach and clearly better than the US one. But maybe that's damning with faint praise a little bit.
Well, I'm just saying overstepping the mark. I'm not saying that the intention was wrong to, for example, avoid greenwashing. I still come across a lot of not UK domiciled investments that carry that name sustainable, and you wonder what is sustainable about you people. So I do actually get the point, which is why I'm saying it needs to be clear in the product documentation what the product is doing and not doing. But to basically make it incredibly hard for a well-managed strategy with very clear objectives to just achieve a particular label is ridiculous. And frankly, I don't understand the difference between sustainable and responsible and why everybody's now focusing on responsible. It also means that a lot of choice is taken away from investors now, and a lot of cost is piled on investors. So it was simply taking a step too far, in my view.
No, that's very fair. But thank you for introducing to a genuinely new experience. So there we go. Of course, on camera. I'm looking at my next question on diversity, and obviously I see it here as a picture of diversity. I accept that. But would you say we're a more diverse and inclusive industry today than, say, 10 years? What can we do? What more can we do?
Relatively speaking, yes, but I think we could do still a little bit better. But in my previous role, when I was with Coutts and NatWest Group, we had a real good graduate program, and what I liked about that program is you could actually get graduates, people who come with the education, no job experience, not influenced already by our industry, just with who they are and what they can do, getting an opportunity to work in an organization. With every year, they are then ending up in job life. They're being pushed into particular directions. So when I'm now putting in a job ad out and I'm looking for a fund researcher, at least 80-90% of the applicants are male, at least. And that's a result of the industry operating the way it does. So if we really had, and every organization should really look at that, have a program where very early on they give people with a raw skill set an opportunity to enter our profession, it would be way better. Now that's just on the gender thing. I think in other areas we are doing much better. And in one area that I think we're really, really bad is age discrimination, frankly. I mean, I think this is not even articulated anywhere, and it's probably a big theme, but nobody's talking about it.
Well, I'm going to be talking about it more and more because I'm being interviewed. I might be coming here just planning for the future there. But there we go. Yeah, sorry, just on the gender side of it, because I'm aware that here we are now, I'm 8 for 8 on choice words and not a lady interviewed inside here. I'm not sure that's my fault necessarily. I could try harder, but so could you in terms of wanting to be on this. If you're a lady from Slater, film researcher, please do give me a shout. Right. Again, completely enjoyed that. There's no segue onto this one, but it's my one of my signature 2 questions. Outside of work, what's the strangest thing you've ever seen or done?
So the most memorable thing I've done was actually climbing the Berlin Wall when it was like on the day after the wall was opened. And the strangest thing I did was on that same day doing exactly the opposite what everybody else was doing, which was walking into Eastern Berlin, which was like an empty place. It was like as some biological weapon had been dropped on that city. It was completely empty, and there was a very strange feeling that I've never had anywhere.
Did you travel to Berlin on that day to be there, or were you there already there?
Yeah, I remember that I was going to uni at the beginning of my studies, and we watched TV, and there was like, this is like history happening. This is like
and you jumped in a car.
First on the moon. And we watched it second evening. We thought, this is really history happening. We can't stay here. So we jumped in the car. We drove through the night. We arrived probably like 2:00 in the morning in Berlin. And then knocked off a piece off the wall.
I was going to say, did you have your brick? You've got your brick.
I have it, yeah. I have a piece.
Excellent. That's a good answer. Thank you for that one. Last question then. We call this choice words, but I'm crowbar into you offering some choices, some recommendations, more cultural. One would be a book, doesn't have to be an investment. One could be a recommendation for anything else, another book, podcast, restaurant.
Well, I'm at the moment I'm working myself through the Anthony Seldon books. I started with Truss at 10, which was just an extraordinary.
Because it was the shortest, was it?
It's well, yeah. By design, it has to be short. I'm now working myself through Johnson at 10, which is really long. And just reading through those two, I mean, what you realize, other than this political aspect of it, is how important it is to have some principles, some morals in what you're doing, and a plan, frankly. And that's a lesson you can take with yourself, and the author is actually very good in distilling out these key lessons, life lessons, how you want to manage a team or manage an organization. So that's I'm still at it.
I think there's important books, aren't there? They really set some context. I think that's right. Yeah. So would you offer any other ones, or those are your 2 recommendations?
Well, at the moment, that would be my recommendation right now. I have to admit, I'm reading research papers, so that's how much as a reading, but this is probably nothing you would want to share here.
No. The Selsdon buyer. No, that's a great call. Great choices. Yeah. Well, Uwe, thank you so much for those. Thank you for the choices. Thank you so much for talking to us today. It's been so interesting. Thank you.
Thanks for having me.
And thank you all very much for watching. Please tune in for future Choice Words videos.